Day, everyone. My name is Rebecca Lilly with the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Stranded Asset Risk and Political Uncertainty. We are grateful to our distinguished speakers for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services you can find at our website at iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our speakers. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for the panelists, please click the Q&A button at the bottom of the Zoom window and type your question. We've allocated time to read and answer them. And now, I would like to introduce you to Thomas Walther. Thomas is a tenured assistant professor of finance with the Utrecht School of Economics, Utrecht University. Thomas, over to you.
Thank you so much. Thank you so much, Rebecca. Welcome, everyone. Thank you so much for joining us to our webinar on stranded assets and political uncertainty. So the idea for this webinar is borrowed from a paper I recently published with co-authors in the Energy Journal with the same title. And we estimate the stranded assets following the decision to phase out coal in Germany for the coal industry by 2.6 billion. And that is many investments in coal-fired power plants were made with technical lifetimes in mind up to 2060, which now have to prematurely stop. So this is the value for the energy companies, which is stranded by the decision to phase out coal by 2038. But this is only a compromise. The Paris Agreement conformant decision would have been to phase out those coal-fired power plants by 2030, which is still an option. So there is a lot of uncertainty still in the room. And even with the current schedule, there are repercussions for the society. The coal industry is a major employer in certain regions in Germany. The phase out also means that it has to be properly replaced. On another note, the stranded assets can spill over to financial markets, for instance, by losses in stock prices for listed companies. And the uncertainty also further increases financing costs, for instance, for renewable energy or for new energy projects. So how can climate and energy policies be designed to account for the complexity of the transition to a net zero economy? And the aim of this webinar today is to provide an overview of the energy transition's dimension and its consequences. And we will discuss the topic from an energy economic, societal, policy, and financial perspective, with a focus on how these levels interact with each other. While I have more of a moderating role today, I'm very happy to have one expert for each of those dimensions joining me today for this webinar. First, we have Maya Kachi. She is Associate Professor for International Political Economy and Energy Policy at University of Basel. We have Pao Yu Ui, who is Professor of Economics of Sustainable Energy Transition at Europa University Flensburg, and Irene Monastarolo, Professor of Climate Finance at Ad Hague Business School in Nice. Before I give the floor to our panelists, I would quickly like to point you out to the Q&A function of Zoom. So please put in your questions there. And also, if you want to address a certain panelist, make sure that you put that in the question. Otherwise, I see it as a general question to the panel. And well, then with no further ado, I would like to give Pao Yu the floor to give us a brief overview on your research on the consequences of an energy transition for the society, for you?
Perfect. Thank you very much for this kind introduction. I hope that you can see my screen now. Basically talking a bit about some of the research that I've done within my research group called Fossil Exit, focusing not only on coal, but also on other energy carriers. But the focus of today's talk is a bit looking at the coal. And as my background is from the German side, especially talking a bit about some of the German experiences, but this is just a very brief introduction to some of the aspects. We've seen in a lot of literature, not only in the energy journal, but in many others, there's a lot of work, a lot of research on how to phase in renewables, how to do this best, etc. But this sometimes then always neglects to also analyze like how's the phase out of conventional fuels working. So basically which political measures are there, but also what will be the effect for a country energy system wise, but also outside the energy system if we look at the energy entire society. So therefore, my take would always be it's not sufficient to focus on how to phase in renewables, but you also have to look at the dark side, and then you have to manage a just and timely transition of affected regions. So especially this terminology, just transition is very much framed already, but we would also like to emphasize that it's not only about being just, but it also has to be timely to meet and to be in line with the climate target, because otherwise, if we do miss climate targets, the costs for society will be even bigger, because we talked now a bit, Thomas also mentioned the stranded assets for companies perspective, but of course also using these company assets to its fullest would come up with external costs for society, which would be much bigger. So therefore, these are all things taken into consideration for political decision makers when taking a decision when to impose a coal phase out in certain countries, sometimes earlier than planned by companies. Therefore, what we see in research is that when we want to switch from a fossil fuel-based economy to a renewable energy system, which may be a bit more decentralized, depends a bit on the region, there's this focus a lot about the energy system. And I myself am an industrial engineer by training, so I like this. It's nice. You can do energy models. You can look at prices, models. Does it work? Does it not work? And we sometimes tend to neglect that our society is not built on electricity grids and the energy system, but there's many more other elements to be taken into consideration. And especially for many countries, also political decision makers will not take the decision for a coal phase out based on the construction of electricity grids and not only CO2 emissions, but there's many other people involved. There's other ministries involved, which are sometimes much more powerful in many different countries. For example, on the structure policy level, you need to take into consideration workers and citizens, the economy and industry, infrastructure, not only highways, but also digital infrastructure, education, research, soft location factors. In fact, in Germany, the discussion is not only about who's losing their job, but also how do we find enough skilled workers. So we have a lot of areas where we want to create new jobs, but we don't have the people. So you need to sometimes also persuade people to move to a region, and you want highly skilled people. And this is sometimes not an easy thing. Then, of course, in addition, you need to finance this somehow in countries such as Germany, but in most countries of Europe, we have a relatively well-functional social security system, a pension system. So you need to take care of people until the age of 63, 65, 67, and then the pension system takes over. In some other countries in the global south, if you don't have this security, also in the US, sometimes being different with respect to some things, you need to take this into consideration as well. And the question is how to govern this. So governance aspects need to be taken into consideration within these things. Just to show and to add some numbers, just to showcase what is the challenge of such an energy transition for a country and where does the push come from. For example, here for Germany, just showing the direct and the indirect workers, workforce levels in hard coal and lignite. Exact numbers don't matter that much, just want to show to indicate that we were at a range of direct and indirect workers at the magnitude of 700,000 people, and now we're at the range of, depending whose numbers you believe in, definitely less than 100,000 people, direct and indirect, in 2015. And then the question is, what is the share of produced electricity from coal? And this is actually on the right-hand axis, has been reduced from 60 to 40%. So from 1980 to 2015, with respect to the electricity sector, this has not been a great revolution. With respect to employee level, reducing from 700,000 people to less than 100,000, this has been a huge impact for society, which has been managed sometimes not that well, which has to be taken into consideration for society. This is a big push, and this had nothing to do with renewables. You can see the share of renewables. The big downturn of employees in the coal mining sector was at the point in time where renewables were very low at 4%. It was not coal versus renewables. It was industrialization, globalization causing these industrial shifts. Basically, renewables came at a later stage. There's also employees in the renewable sector. You can see the colorful bars. You can see we had 100,000 people working in the renewable sector and PV industry in Germany, which were strongly reduced as these jobs were shifted to China. So there's additional effects to be taken into consideration. Basically, my last slide, just to wrap up some things and to kick off the discussion. Very simplistically stating, of course, different challenges prevail for different countries and regions. So you always need to look at the specific case. Technical solutions are still complex, but comparably easy and well researched. Not saying we don't need more research, but saying that social political aspects, from my understanding, are much more difficult and much more challenging and need even more analysis and a stronger focus. It is crucial to prevent any new stranded coal or gas investments. Any money you put into coal or gas that is not in line with 1.5-degree targets will be stranded at some point and therefore will be wasted. So therefore, we need all this money going into more sustainable technologies. Coal regions that start the transition will receive the biggest financial support, political support, and have therefore the best chances to diversify and improve. If you, on the other hand, try to ignore this trend, if you're a company ignoring this trend, this will result maybe in a delayed collapse, but it will be collapsing at some point with much lower chance for recovery. In addition, of course, to the climate crisis hitting us also. Therefore, not doing anything is not an option, no matter whether you like it or not. Coal is going down for economic reasons, and therefore it is important to diversify early enough and look for different alternatives for you as a company or for you as a region. And therefore, these are just some of my findings from the research, and therefore heading it back to you, Thomas, for the next brief input.
Thank you so much, Yu. Then let's move over to Irena. Maybe you can give us a little bit more insight on the role of finance and the financial system in the energy transition, climate transition.
Yeah, basically my research focuses on understanding to what extent and under which conditions finance could enable or hamper the transition. So basically what role finance could play and how to foster the role. I mean, the role that we would like to see according to the Paris Agreement, Article 2C.1, so scaling up finance for climate mitigation and adaptation. And basically what this is an application we did together with the European Central Bank. The focus is trying to understand the double and to quantify the double feedback that exists between climate scenarios of physical and transition risk, which is, for instance, what the Network for Green financial system provided. So scenarios of orderly, disorderly transition and hothouse world, basically orderly transition when is a scenario in which we introduce climate policies such as carbon taxes early, meaning that the cost for adjustments from switching from high carbon to low carbon technologies and activities in the economy will be lower, and so lower will be the asset price volatility for investors. In contrast, we have a scenario of disorderly transition in which we introduce climate policies late, meaning after 2030, and these policies will have to be costlier in order to stay within the carbon budget. So how many emissions we can still put in the atmosphere in order to get to limit global temperature increase to below 2 degrees by the end of the century. And finally, we have scenarios in which we just go on with the policies we have now in place, which are not enough even to deliver on the Paris Agreement target of below 2 degrees temperature increase, and in which we will have high physical risk, and this is hothouse world. So the first feedback on the top of this double materiality pertains the translation of these scenarios of physical and transition risk into adjustments in the economy. So physical risk will, for instance, imagine floods, droughts will affect capital stock. In contrast, transition risk will lead to higher production cost and changing revenues, lower revenues for high carbon and fossil fuel activities. So from the translation of the climate impacts in the economy would affect then adjustments in performance of firms, depending on their location when we consider physical risk, or their energy technology profile when we consider transition risk, with fossil fuel and high carbon activities facing the higher costs. And this in turn would affect investment decisions of companies, so through their NPVs, but also then affect employment, salaries, wages, and GDP. And from the real economy, we then have a feedback on on the financial system. Indeed, investors that are exposed to economic activities and firms, if the firm performs worse, then the value of their assets will decrease, and so there will be an adjustment in the probability of default and risk metrics for the investor, like the value at risk. And this is the first feedback, and we analyze this feedback more recently, for instance, in the context of the euro area economy and banking sector. On the left, we found the implications on adjustment in real GDP of the disorderly transition with limited physical risk, which is the yellow bar, disorderly transition and average physical risk, which is the blue bar, and Otto's word, which is the red bar, in comparison to an orderly transition. And what we see is that there are main co-benefits in terms of avoided GDP loss of doing the transition early. And the co-benefits are also on the right in terms of GHG emission reductions, so decarbonization for the European economy. However, there is also then the second feedback, which goes from the fact that investors do look at the climate scenarios because they have to do, for instance, to use them to do climate financial risk assessment and climate stress test, and thus they might decide to adjust the risk assessment and cost of capital for firms, depending on firms' exposure to transition risk, and this in turn will affect firms' investment decision. So how do we capture all of these? We capture them in a framework for climate stress test, which we developed in 2017, and we published on Nature Climate Change, and has been then further revised and updated so far. So we start from the trajectories of emissions coherent with a temperature target that are analyzed by, for instance, provided by the IPCC report, so Intergovernmental Panel on Climate Change, and more recently by the Network for Green Financial System. These emissions translate into adjustment, the emission trajectories translate into adjustments in the output by sector, depending on the energy technologies, where fossil fuels-based technology will go down and low carbon and renewable energy technologies will go up, which in turn will translate into shocks in the performance of firms, positive for renewables, and negative for high carbon. Here we are an example of wind-based and gas-based electricity. And from here, we adjust the valuation of the contracts and securities of the firms, such as equity bonds. And from here, we adjust the risk metrics of the investors that have invested in such firms. Here you have an example of the value at risk. Considering also the network effects, so the reverberation of losses in the financial network. And the results that we found already in 2017 is that investors were highly exposed to activities that were climate risk relevant. In particular, here you have an example for transition risk for the largest banks in the world. And these exposures could translate into large financial losses on the value at risk if, for instance, the banks, here you have a list of main banks in Europe, like Deutsche Bank, Crédit Agricole, and so on, would go on with a business as usual investment strategy, which is mostly high carbons, which are the brown bars here, and the losses would be very relevant in comparison to a green investment strategy, which is what you have on the right. Interesting, what we see here is that losses could be driven by different financial characteristics of the investors. So for Deutsche Bank, mostly there would be first-round losses because, for instance, the bank has directly invested in fossil fuel or high carbon firms that will face a negative revaluation, while others, which are the lighter bars, will mostly face losses due to second round or third round losses, so indirect effects, because they invested in other banks that in turn are directly exposed to high carbon activities. Thank you.
Thank you, Irina. So then we saw already perspectives from a societal and from a financial aspect, and then maybe Aya can walk us through her research on the policy design process.
Yeah, thanks. So as was in Thomas' kind introduction, my research is in the intersection of, international political economy, climate policy and energy policy, or more broadly, sustainability policy, but also public opinion. And so in other words, while I keep an eye on, so these graphs are not meant to be for your examination. I'm just putting a representative graph that might indicate my research area. So, but if you're interested in coal, you can also look at the graph. So in other words, while on the one hand, I keep an eye on different policies like coal phase out, or also coal non-phase out, right? So policy that is not on political agenda yet, a policy that is not chosen by government. So on the one hand, I look at these different policies that come out of different countries and why. I've been also looking at how and under what condition people decide to support or not support these policies. So that's the public opinion part of my research. So you're probably wondering how these themes in my research are actually connected to today's topic, which is stranded asset, or perhaps more broadly, sustainability or sustainable investing, sustainable investment. So let me walk you through this connection in this overview to kick off. So this question, so how is it related? Public opinion, countries' public decision-making, how is it related to investment? So this actually brings us back to one of the most classical questions in political economy, which is state and market. Sometimes people think of it as states versus market, and what are the roles of these two actors, right? And how they function, how they divide their roles also depends on the relationship between states and market in different countries, and it differs across countries, of course. And what I can tell you from the beginning is that policies are not meant to directly control our investment behavior. So it's just not supposed to be. Even though there seems to be an increasing number of people who kind of believe that financial institutions should do this or should not do this, banks should do this, banks should not do this. But policy's role is not meant to be like that. So what do policies and regulations do? This is how we think as policy analysts. So policies, regulations, these public decisions are meant to set legally binding national goals. So concrete national goals. So it can be called phase out, but also more broadly net zero goal by so-and-so year. This much of emissions reduction by so-and-so year. So these long-term goals must be set, right? So that's one of the goals of, one of the role of these policies and regulations. And on top, these national goals normally come with more concrete measures to set right economic incentives for households and businesses to perhaps shift their behavior. So the effect of policies on investment is indirect, but there is a connection. Now, so, and since probably many of you here and we are sort of economists, it's very simple to say, well, policy sets the right economic incentives so that smart investors would take first mover advantage. They would quickly shift their investment behavior and so on. But for good incentives to be able to become policy, there needs to be public support in any democracies. The reason is the following. You might be thinking, well, economic associations and lobbyists are shaping policies. Well, that's true, but policymakers cannot even think of putting a certain policy proposal as a political agenda if there is absolutely no public support. So actually public support, public opinion is very important in this regard. And I want to wrap up this kickoff part by laying out some of the quite complex challenges that I see in relation to public opinion and policy and investment. It's about the costs. But it's not necessarily about the cost that Thomas' paper is nicely estimating. Paul's paper is nicely estimating in terms of labor market effect, and also Irene's work. But the cost that matters for public opinion is actually the cost perceived by the public. And somehow we, policymakers, scientists, have been really struggling to get a good grasp on how this perception of cost is shaped. And I'll give you 3 examples here, and I'm happy to dig deeper into any of some of these points later. So voters, or at the same time, they're consumers, their perception of costs are not necessarily the same as experts' calculation, right? So here we are talking about a stranded asset, but have you ever heard of voters around you who are discussing coal phase-out policy, really laying out these numbers that we are talking about here? 2.6 billion euro, 11 billion euro additional. Have you ever heard of it? And also the type of costs voters talk about and care about may not be the same as what we are discussing, what policymakers are discussing, at least on the proposing side of the climate policies. Also, there is this very powerful, even though simple narrative that is often used by the opposition of any climate and energy transition policies, which is, but the policy costs our economy. And I have been observing various policy debates, and this narrative is very simple yet very powerful. It unites various corners of voter base to eventually sort of shape overall opposition toward, for example, carbon taxation and so on the national decision-making level. And this narrative is convenient, and also it sounds legitimate, and it sounds like the motivation is in economic calculation. However, I think we need to do more research on what sentiments this narrative is actually capturing. Is it really a representation of true fears for economic loss by the public? Or at least partially, is this sort of a discursive legitimation that is actually veiling a lot of identity and ideology-based preferences for these preferences against these policies? And until we figure that out, for example, compensation policy that goes with carbon taxation and so on may not have an effect, positive effect that we scientists expect. So with these challenges, I would like to wrap up my part, my first part, and I'm looking forward to further discussion.
Thank you so much, Aya. So I think we got a nice overview about the societal aspects, the financial system, how it's involved, how it's kind of put between the policies, the society, and also now the difficulties of shaping the policies in general, looking at voters, understanding public opinion. So I would like to kick off a little bit the panel discussion. In terms of policies, what do you perceive as the biggest threat? So is it more a strict climate policy following the targets of the Paris Agreement, or is it more a compromising policy, taking the views of all stakeholders, lobbies, including the industry into account, or a more reactionary policy, which follows more the current media attention, or is very focused on voters? Anyone would like to start?
I can otherwise make a first brief comment without trying to make a long monologue. I think for me, the biggest threat is that the government is not giving any clear signaling of where they see themselves in the next 5 or 10 years or anything like this. Like any irrational of non-behavior, no action at all. Nevertheless, everybody around knows that something should happen is worse because it doesn't give any stringent long-term planning security which investors might need. As we see this in Germany, that there was no real indication how the heavy industry should transform, and at some point just the heavy industry literally knocked on the door of the energy ministries at the economy ministry. We're like, we need to invest into our steel boilers because we haven't invested in the last 10 years because we kept waiting. What is the carbon neutrality goal? Is it 2050? Is it 2060? Is it 2045? We need security now because we need to take decisions now. So therefore, not acting or also coming up with laws where everyone knows, well, these will be changed in 5 years because it's not in line with what is needed. So therefore,
would you agree that also for finance or for the financial system, like a more long-term perspective of climate policy is needed?
This is fundamental for investors to calculate adjustments in risk and return and in for portfolio rebalancing, but also for risk management. And we keep on saying that finance should play a key role in fostering the transition and in adjusting the risk weights, for instance, for banks, for high carbon, low carbon firms. But the point is that how can investors do it if they don't have clear signals to be able to discount future cash flows of firms depending on a firm's exposure to physical or transition risk. And these clear signals should come from policies. So we need long-term, credible green industrial policy and credible climate policy commitments in order to anchor expectations of investors and signal the market. This is fundamental. And in this regard, global common yet differentiated carbon tax would be the first best solution. So until we don't move in this direction, it's very difficult for investors to move ahead. That's until it doesn't make yeah.
I from a policy perspective, what is your opinion on that?
Yeah, I mean, I completely agree on, what the other two panelists have said. And that brings us back to also this reactionary and media related problem as well, right? So I can't really pick the biggest problem here. And since Irene mentioned nicely, this carbon taxation, this market oriented, very well calculated, proven to be efficient and effective economic mechanism, that is so unpopular by voters, and we don't know what to do with it. So I'm showing the graph that is based on a pilot survey from a week ago, very fresh. And it's a pilot survey, so N is only 200 and with UK residents, but I can guarantee that if you look at any existing surveys, large scale surveys like European social surveys, ISSP and so on, you would see almost exactly the same result, which is the following. So from the scale from 1 to 5, this is asking the public how much they would support, oppose or support policies to reduce climate change. The left side panel is about taxation-based policies. The right side panel is about regulation and ban-based policies. So the mean is almost one Likert scale different, and taxation is that much unpopular compared to regulations and bans, and the difference is statistically significant. So this is a very common pattern that we see among voter sentiments, and this is not exactly how economists have been thinking. And now also this media effect added to this sentiment is that even though we are needing very strong and clear signal, long-term signal from the government is under this electoral pressure. So they would like to please various sides of voter base. and voters are definitely not preferring taxes. So this is one of the reasons why we are kind of standing in the same place for decades. And sorry, I cannot give you a great solution to it, but this is how I see the problem.
Thank you so much. Thank you so much. Yeah, I see we're coming to a vicious circle where society is the one who's impacted by maybe most by an unorderly transition, but also somehow the one who has to get the kickstart to have that understanding, to give to have the right opinions, in that sense, the right opinions for policy making. By you, what do you think needs to be done to facilitate the transition and ease the burden for the society, the costs or the perceived costs I was talking about, but also the realized costs you showed us, Payu, in your presentation. And especially also the vulnerable part. So I also know that you do research on a global south, so in terms of the just transition. So yeah, that's the first question I have to you. And the second would be, do you see differences there when it comes between developed, emerging, and developing regions?
No, thank you very much for the question. I think one of the most important words, also in things that Aya mentioned, but also in other things before, is like this word perceived in some cases, because also, like, for example, in Germany, like people are feeling everybody is relatively well off compared to the global south, for example. Nevertheless, some people feel left behind, and some people are also left behind. And this is a phenomenon that we've seen in the past in coal transitions in Germany, in the eastern part of Germany in particular. We've seen it in the UK, the Rust Belt. We have seen it in the US, basically. And these are then kind of regions where people in the downturn of the coal as well as the steel industry were feeling left behind. In some cases also often were left behind. There was not enough structural policies to ease the transition. The regions didn't find a new identity. They didn't have a new meaning. They were basically falling into a hole, literally, basically not knowing how they can contribute to society, feeling left behind, voting for more extremist parties in some kind, also being partly responsible for the Brexit. In the UK, it's those regions voting for the Brexit. It's those people voting for Trump. So you see these tendencies we have in the eastern part of Germany, these people voting more for the right-wing parties. So basically, there's a lot of consequences coming with this. So therefore, how do you basically not how do they not feel left behind? First, about this perceiving, it's about transparency, it's about information to explain to people why some changes are necessary, why some things are happening whether they want it or not, because coal is not economic anymore. The companies, the investors will draw out and will invest into other things, no matter whether the politicians sometimes like it or not. It's sometimes globalization, other things, some things just happen, but you have to inform people and have to explain them in some cases that it's not meant against them, it's just how trends are. That's more about this perceiving end than about the fact that they sometimes are also left behind. You need money. You need financial transfers in some cases. Also, you need to be honest. You can't save every job. You can't save all industrial centers. Industrial centers will move. This is normal industrialization, and therefore you can redirect it up to a certain extent, but in some cases also it's fine if some cities, less people live there. We have a big problem anyhow of shortages of skilled workers in some areas. Just about directing it, sometimes easing the transition. So therefore, it's about financial transfers, which is a political then their job to explain it and to do it. In the global south, it's of course even more complex, because the difference between the existing inequality is much higher between the rich and the poor people. And most likely the rich will find alternative ways, the poor will be left behind. We see this in particular within the coal sector. The companies that have sucked out the money, these are international companies. And the mining companies in the global south, they are from Switzerland, they are from the US, they are from Europe. They are not Colombian or South African. So basically they have extracted the money and they will now leave the country. There are basically some mines in Colombia which were left during the COVID times. They were supposed to be just left for a couple of days and weeks because it didn't pay off to keep it running. The investors never came back. because it doesn't pay off still. So basically the mines lie there for the last 2.5 years untouched. The machinery is still lying around. The people left without a job. There's no renaturation. There's no social welfare. There's nothing. The area is toxic, so basically cannot be used either. So therefore, this is what will happen to many of these areas. These are stranded assets capital-wise for the companies. They go to another area. They will do mining in other countries, in other sectors, switching from coal to gold, whatever. But basically the communities are left behind, and therefore it is important for political structures to enable that those that cause the costs for society, for nature, for climate, that they somehow pay for these costs to some extent. There are sometimes some liabilities, sometimes there's laws in place to basically safeguard money from companies when they still have the money, to basically make sure that they pay for what is left. So I think this is important. So transparency, inclusion, justice are basically these aspects. And especially I think you need justice. And in many of these countries, it's not only a just energy transition, but it's a just transition. It's about not switching from exploiting the countries in the global south by extracting coal to now extracting renewables, big PV farms, big wind farms, hydrogen, and the local population not profiting from this. It's about inclusion of these people and give them also a share of these things. And therefore, there are some possibilities also with respect to renewables to do it in a more sustainable way, community involvement, increasing the acceptance, etc. And therefore, there's a possibility to set up a new energy system that enables more inclusion of actors and therefore doesn't replicate injustices of the past.
Thank you, Paulo. You also mentioned that investments are needed, that money is needed. And if I saw your presentation before, Irene, you had those 3 pillars, but the financial system and the society, there was no direct link. It was more the link between them was the energy transition. But do you see how the financial sector can help to help society to ease the burden in the energy transition?
Well, more than the financial sector, again, we come back because what Paulo just said is just an issue of how you design the transition and how you implement the transition, because already what we showed in 2018 with the air install flow consistent model, a carbon tax could have large distributive effects and increase inequality if in the end companies just that are supposed to have higher cost of the carbon tax just transfer the cost on consumers, which is what we saw also very recently during the energy price crisis. So the issue before asking what finance could do is mostly, how do we set how governments and regulators set the rule of the game for the transition, meaning how do we design and implement the policies, and these policies should be implemented in different ways depending on the countries, because of course we see in Europe there is a mechanism for just transitions for allowing for paying the restructuring of the economies in areas which are still highly reliant on coal. But even in countries where this should be most relevant, like in Poland, in the end, when you look at how much is coal really relevant on employment, GDP, these are very small niches. So because the transition has already occurred in the last 20 years in the passage from the state to the market economy. The problem is a problem of how this transition and how the economic development has unfolded. And here we are all very well aware of inequality. Also, you mentioned before about economic and industrial transformation, some sectors that should shrink, but maybe we should focus first on the most we look at the marginal, we are economists, we look at the marginal opportunities and costs, and how could we ask people to consume, poor households to consume less when we allow very high income people to still fly with the private jets. So actually there should be an issue of equity, and all these should pass through economic policy before even finance. And then finance will follow because we'll adjust its risk returns, calculate its alphas and betas, and will adjust its investment decisions. But before that, we need, again, credible policies. And then once this is in place, there are several options for in terms of green financial sector initiatives that could be implemented depending on the characteristics of the country and of the markets in financial, but also low carbon transition challenges and climate physical risk exposure challenges. We explored some of them in a recent publication together with the World Bank on what role different types of green financial sector initiatives, which involve fiscal, but also monetary, micro and macro prudential, and also soft lending could play. But there is a range of instruments that could be tailored and deployed, but we need first to have a clear rule of the games that don't create inequality by design in the transition.
Thank you, Irina. So it kind of comes back to the voters, to the society itself. But how do you see? So how could climate policies then be shaped to account for the burdens of the society? So what hinders? So I understand it's the voters. From you, what I've understand so far, it's the voter themselves hinders the policy to arrive there.
Yeah. So once again, oops, what is happening? Sorry about that. Let me. Yeah, once again, I completely agree with everything that has been said by the other panelists. And Thomas has just thrown a huge question on me. So how is it going to work with policy? I want to dig a little bit deeper into how you mentioned as packaging compensation explicitly, and with transition policies such as coal phase out or very difficult carbon taxation and so on. I have to be very clear that these graphs are coming from my working paper with Malcolm Fairbrother and Sabina Ramos Gonçalves, and this hasn't been peer reviewed. However, I just wanted to show you part of our analysis. This is based on a very famous existing survey of 20-something European countries called European Social Survey from 2016. A little bit outdated, but it has many environmental policy items. What we have here is this. Okay, so these dots numbered are basically people's job background. So what industry these survey respondents work in, right? So pooled across all the countries, 20-something European countries. On the x-axis, it shows each included 20-something industries emission level, right? And on the y-axis, we have the support level of these respondents regarding fossil fuel taxation. And what we see, sort of, is that when people's job background is linked to a higher emitting industry, right? So that can be a source of personal economic fear related to policy proposal, then the support of these people for carbon taxation, fossil fuel taxation decreases, right? So that just shows our intuition. And also, if we look at the country level emissions, so in these 20-something European countries, there are countries that are heavily relying on coal and so on, and there are countries that are not relying on high emitting industries in terms of job provision, okay? And we call it structural power, so how much these above median emitting industries are providing job to these countries. And it turns out it also correlates quite well with people who are living in those countries' support for policy. And there's a duality problem. This is showing, we can't say much about causality, but this is suggesting that if you live in a country on average that emits more carbon, and if you have a job in high emitting countries, and you're less likely to support these climate policy, right? But these are exactly the countries that need to reduce more emissions. So again, we are stuck. However, if we look at similar trends in people's support for renewable energy subsidies, for example, so different kinds of climate policy, then this kind of correlation is not found. So basically, people's support levels for these policies are less linked to their job background, right? And high emitting job background. And this probably substantiates what and enables what Paul suggested, which is that, so when there is an effective climate policy that government wants to pursue, then perhaps it is strategically also economically making sense to package it with a secondary compensatory policy that really temporarily targets and helps out the losing subsegments of the economy. And we have to be pretty explicit and transparent about that. So that's what I wanted to share as a hopeful side of the story.
Thank you so much, Aya. So another question, Irene didn't want really, she kind of answered it, but she didn't really wanted to say like finance can do something first, has to come from policy first to set the boundaries. But let's say that is given. So where do you see the role of the financial sector in the interplay between climate change, society, and policy making? Maybe we can go the other way this time and start with Aya first, then Paul you, and then Irene can finish that.
Sure. So I'm really curious what you guys say about this, especially because I'm not coming from financial analyst side. So I'll be quick. I think among the general public, I feel I might be being a little provocative. I feel there is a bit of misunderstanding that under certain circumstances, financial sector should not pursue profits. And I think it's wrong. So financial sector should be doing what they have been doing, which is to maximize profit and keep the economy intact. So I do agree with Irene that actually it's policy and public decision-making arena's job to set the goal and incentive to guide investment behavior in the financial sector. That's my input.
Maybe just continue, just also briefly. If it's basically, I know that there's a lot of rules and financial institutions also have to compete with one another. It's not like the financial sector, but it's individual firms, of course. But in general, what we are needing for the energy transition and the just energy transition to work is we need money, and we need cheap money. And especially in the global south, this is not available. In Germany, it's easy to get an interest rate. Interest rates are still very low. But if you have to pay interest of, I don't know, 15% for renewable installations where you need upfront investment to basically buy in, then this becomes difficult. This is the difference between renewables and fossil fuels. For fossil fuels, a large chunk of the costs are running costs across the lifetime of the power plant. For renewables, you need upfront, high capital intensive investments, and this is difficult for the global south. So if there are means to enable cheaper credits for the global south in technologies where we know that they are working, because we know that PV can produce a lot of electricity in the next 15 to 20 years, so the money will come, then this is good. I think there are some measures like the Just Energy Transition Partnerships, where there's the aim of the global north to allow public and private finances at cheaper rates to the global south. At the same time, there are some countries which are overburdened with debt at the moment and therefore cannot invest in anything. So if there's any way to basically lower the amount of debt for some countries, this would enable them to act, and otherwise not acting will be more expensive for our society. So reduction of debts, maybe linked to climate targets that they comply with, would be also something macroeconomically speaking helpful.
So basically, in all of these, the role of finance is to properly assess risk and opportunities of the transition. And unfortunately, I don't agree on the fact that profit maximization goes hand in hand with making the transition, because so far, and that's much linked to the models that are used to assess the cost of benefits of making the transition now and later. Actually, standard aggregate integrated assessment models that coming from the US actually showed that until we don't reach 3 degrees temperature increase, it makes no economic sense to introduce climate policies. And this is, of course, a major limitation for making the transition. So on the one hand, we need to improve climate economics and financial modeling, and there are alternative models that already show that there will be major cost of inaction if we do internalize climate risk and opportunities working with the scenarios, and the main co-benefits of doing the transition now and not in 20 years. And these co-benefits will be felt both in the economy and in finance. And then, based on these adjustments in performance of firms, financial actors should internalize this information in their adjustment in financial valuation and risk assessment, and based on that reallocate the portfolios and provide, actually adjust the cost of capital, making it differential and increase it for, or even avoid new lending to high carbon and fossil fuel activities, simply because the model should show that these are riskier. And the opposite, of course, for green. But, you know, it's very difficult to disentangle the climate economic from the climate finance side. These are very much connected. And that's why we need to strengthen and modeling and to be clear about the internalization of climate risk and opportunities in the economy and finance, and to then a better and leading to a better assessment of the cost of inaction and the co-benefits of early action.
Thank you so much, Elena. Before we come to my last question for the panelists, I also would like to to point our participants to the Q&A again. So after our last round of statements to the last question, I'm happy to read some of your questions. So yeah, I was already kind of showing that we want to go to the last question, and so just to kind of also to conclude this discussion, who do you see as the main protagonist in steering the energy and climate transition? Because what I feel is that we are kind of a little bit stuck. We went from the policies on the energy transition, where finance can only follow the policies. The energy transition is then realized most on vulnerable parts of the society, which also have this perceived costs up front, which then hinders or hampers the policies in the first place. So who do you see should kind of move first? Paul, you maybe.
So I would say that in an ideal case, I would expect the government to basically take all these things into consideration and provide the right setting for this, and then to explain to the population also why we're doing this. I think Aya pointed out a lot like what the population thinks, but you can also persuade people to shift their opinion. You can explain things, you can frame policies differently, etc. So a good government can do a lot and is not doing enough in most countries that I'm aware of. What we see more in reality at the moment, I would say, is we see progressive industries side by side with NGOs, with activists pushing forwards, guided by science, which is not the worst, but it would be nice if governments would be also providing the setting. But it's really more the push comes from the progressive industries, seeing also possibilities to earn money. And of course, climate activists are always at the forefront by demanding, but they're not in power. They don't have the power. So therefore, the push only becomes powerful once progressive industries sideline with these voices.
Lena.
Financial regulators have often been mentioned as the second best solution, but indeed they could play and are already playing a big role in steering the financial sector towards the internalization of risk and opportunities of climate change and climate change mitigation and adaptation. So this is for sure in absence of coherent climate policies and the key role of the government, as was just mentioned before. This is a powerful tool for investors to adjust their risk assessment and investment decision.
Yeah.
Yeah, this is another big question. You know, within the government, meaning a parliament or Congress and so on, we often criticize the claim, arguments, and attitude of the opposition parties. But I have been wondering if the role and the activity of the proponent side in the Congress, in the government, if they are doing, you know, what they should be doing. I think, Paul, you mentioned transparency, honesty in this cost-related, you know, not just perceived, but cost-related discussion. I feel like the opposition side is raising a legitimate question. Isn't this policy too costly for us? And I feel like there's not enough direct answer to that opposition argument from the proponent side in the government. And so here I would like to see change in policymakers' attitude. Instead of saying this green policy is good for us, I also want them to answer how the costs are estimated and how the cost can be managed in the next short term, long term. So that's something that I want to see. And I also wondered if there's a bit of role in education. I wonder if voters, including us, can be a little bit more exposed to this logic of economics, or logic of finance, to really understand what we mean by cost and how it may be different from the image of cost. And I wonder if there is a role in education as well. Yeah.
Okay, thank you so much, everyone. So from my understanding, it's a call for governments to also for make sound decisions, good communication with voters, to get the kickstart, and then lots of things can follow. I have so far one question. I think it's so the others should not hesitate to also give their opinion, but I think it's mostly directed at Irena. Do you think markets are mispricing climate risk? And if so, are banks being misled in their mission to make money due to potential mispricing of climate risk, and therefore have a distorted picture of their clients and their own long-term profitability? I think you can also see the question in the Q&A.
Yeah, well, actually, financial actors are pricing a certain type of climate risk, which is what we saw for the past, but are still but the problem is that climate risk in the future, climate risk is forward-looking, meaning that the future will be very different from the past. So what we should expect for the future will be much larger risk if we don't act than what we see in the past. So even if we see that investors are somehow responding to emission disclosure of firms, which however is very poor and heterogeneous, or responding to specific natural disasters, they should be prepared to consider the scenarios of climate change and climate risk, which would be much worse. So far, even if some investors are pricing some forms of climate risk, they are pricing only a small part. And that's why it's important that they start to look and work with the scenarios, as the NGFS, as the Network for Green Financial System, as recommended.
Okay. I guess the other two, you don't have a explicit opinion on that?
Maybe just sort. I think there's different things linked to climate also, which investors have to take into consideration. I think, for example, if I would be an investor and the question is, do you want to finance this coal power plant? Then, of course, this coal power plant would have an impact on climate and therefore reduce value of many of my properties. However, the impact of this one coal power plant is very small. So therefore, this additional climate risk through my investment is relatively low. So therefore, this is not having a big impact on my decision. Nevertheless, sometimes also there is this risk that I'm investing in a portfolio, which due to climate laws will turn up being less valuable or might become stranded. So therefore, I think this is the biggest risk that financial actors will be cautious about. So basically investing in anything that is worth less. And then of course, so this is something to take into consideration. And therefore, once again, we need governments, but it's also not only on the governments, but to get good governments, they need the votes beforehand. They need the majorities in some kind of cases. So therefore, also, I think it's on all of us to work on communication of our science, that it's better understood by people, but also other agencies are needed to explain to people why we need certain things, so that voter preferences in some kind of way can be also shifted in a way so that majorities can be there in governments to then do the progressive regulation that actually even the industry will need.
Yeah, thank you. Now, I think in some sense, the not incorporation of climate risks on long horizons risk in financial models is also somehow miscommunication from the modeling to the decision makers. So in that sense, it also boils down to communication in that regard.
Yeah, and even just the idea, sorry, that we can edge climate risk. It's basically not properly. Not. I mean, it's not. Let's say it's not really honest.
Yeah. So, if there are no further questions in the Q&A, and I think we are already a little bit over our time, I'd like to thank you all for joining me in this panel discussion. It was very insightful to me. I hope so. It was also very insightful for all the participants. And again, thank you so much. And then back over to you, Rebecca.
Well, IAEE would like to thank all of you for such a insightful and well-run webinar. This webinar will be available on IAEE's website for future download. If you're not a member of IAEE, we encourage you to join by visiting www.iaee.org. We thank you for attending, and I officially close this webinar.